Now we are going to solve problem number 67 out of a problem book. And this problem requires compilation of a cash flow statement for the company for the financial period, for the financial year ended on 31st of December 2019. In that particular task, we are given with two balance sheets and no income statement. But basically, for the purposes of cash flow statement compilation, we need some information from income statement. At least we need to find operating profit. How could we use balance sheet in order to find profit of the company earned during the financial period, earned during the year between these two dates? I believe we can look at capital section because capital from year to year increases by the amount of profit earned during the financial period. And here we can see that each year in the line net profit, accountant adds net profit for the year. And for the previous year, 2018, opening balance of capital was 35 and something. Net profit was added, zero cash introduced during the period, and the total capital at the end of the period was 46,000, which is sum of two previous lines. Then the owner of the company withdrew some amount of money, and the ending capital, opening capital plus profit for the 2018 less drawings, eventually is used as opening capital for the next year. So the next year is opened with a capital of 33 and something, and net profit here could be taken from here for the purposes of cash flow compilation. So let's start our cash flow with the proper name, which reads R. Lester. Cash flow statement for the year. We use period for cash flow statement because cash flow is compiled for the period cumulatively, not at the certain date. For the year ended 31st of December 2019, and we have to state the currency. All amounts are in pounds, and this is the proper name. The first line of cash flow, always profit, and here we are given with net profit only. But what is net profit? Let me remind you. Basically, our proxy profit and loss statement could be like presented like this: sales or revenue less cost of sales. The first profit which could be calculated is gross profit. Gross profit, okay, I will use the proper name, gross profit, is the first profit which could be calculated in income statement, and this is the profit from the main activity, from the operating activity of the business. And in our case, it's a merchandising activity. Then we have to add other income other than operating activity. We have to deduct other expenses, and eventually the company could calculate profit before interest and tax, also known as operating profit. And sometimes we use earnings before interest and tax. They are synonymous. I don't like to use that abbreviation in Russia because it's like бранное слово, обсценная лексика. Sounds like бранное слово. But nevertheless, we do know that the second profit which could be calculated is operating profit. Then we can deduct out of operating profit interest expense, and we will calculate profit before tax. Then we will deduct tax expense. And after the deduction of interest and taxation, we will receive net profit. So eventually, if we assume that interest expense is 0 and tax expense is 0, net profit is equal to operating profit, to PBIT. Let's look at our problem. Let's find something which is similar to tax or interest words within given information. I cannot find. Can you? So since we are not given with any information about interest expense and tax expense, we assume net profit to be equal to PBIT because we have just justified that net profit would be equal to operating profit if there is no tax expense and there is no interest expense. So let's start our cash flow statement with operating profit of 11,070. That amount was taken out of capital section balance sheet line that reads net profit. This is the net profit of the financial year which ended at 31st of December. So this is the net profit earned during the financial period we are interested in. Then we have to adjust that operating profit calculated under accrual basis, adding back all non-cash expenses and deducting all non-cash income. So basically, we're going to have maximum 3 lines here. We have to consider depreciation expense for the period. We have to consider profit or loss on disposal of non-current assets. And we have to consider increase or decrease in provision for doubtful debts. Bad debt provision. And basically, we're going to have on the maximum 3 lines here. Maybe some of that lines would be blank. Let's talk about depreciation. Do we have any information on depreciation in our given information, in the wording of our problem? Eventually, yes. We can find the special line reads depreciation written off equipment during the year was 2,610. Written off equipment is a common English saying. Списано против активов. То есть это не та амортизация, которая относится к списанным активам, как многие русские могут переводить. Нет. Это depreciation which was charged during the year on assets held during the year, held and used. So this is the depreciation expense for the year, and since it was previously deducted out of income in order to calculate profit for the year, because depreciation is definitely expense, but it's not cash expense, it's not something which would be paid in money, we have to add it back in order to come closer to cash movement from the profit. So that amount, 2,610, should be added back. Wait, to change. Then we have to consider any sale of non-current asset. And in notes, in a special line, we are told that equipment with a book value of 1,350 was sold for 900. And it's not so difficult to calculate that the company had loss on disposal. If we compare net book value with the cash received, we can see that it was sold with a loss. And that loss calculated using accrual basis, so it's not something which would be received in cash, because basically the company received 900 pounds in cash. And that loss calculated using our incredible math skills was deducted out of income statement as non-cash expense. And now we have to add it back. Again, all non-cash expenses should be added back. So difference between these two amounts, 450, should be added back. And I will leave only word loss on disposal here because it was loss. And the last thing we have to consider in terms of non-cash items, we have to look at bad debts provision. We can see that at the beginning of the year, bad debts provision was 420, and for current year, the revised provision is 800. That means that the provision increased, and increase in bad debt provision means that the company expects to lose more money than last year. So it's a predicted loss which should be counted right now. And basically this difference between bad debt provision was already taken as expense, was showed as expense in income statement. So we have to consider that non-cash expense from income statement and add it back again, because bad debt provision is not something we will receive in cash for sure. So we have to add back increase in bad debt provision. 380. Basically, these are all non-cash items, and I will leave here increase word only because increase is an expense which should be added back. Now we have to consider changes in working capital. Do you remember what is working capital? Basically, working capital is current assets and current liabilities. So within current assets, we are interested in changes in inventory or stock, and changes in accounts receivable. In current liabilities, we're interested in changes in trade payables or payables. So we have to consider changes in payables, current liabilities. Let's have a look at current assets. Within current assets, we have a line which reads stock. Stock is a current asset, goods for subsequent resale, held at our warehouse. And during the period, we can see that the total amount of stock decreased. What it means? Being other things equal. Let's assume that that nothing changed except for stock. If stock was sold, that means that cash increased because that sale was paid in cash. And basically, that difference in stock would affect increasing the cash on our bank account. So if current asset increases, cash decreases. If current assets decrease, like here, stock decreases, cash increases. So difference between these two amounts should be accounted for as increase in cash. Let's calculate the amount. We have to compare the opening stock 18,570 and closing stock 16,250, and that difference 2,320 increase in stock should be added for the purposes of cash flow calculation. The same for receivables. If we compare receivables at the beginning of the year with the receivables at the end of the year, debtors is the synonymous to receivables account. We can see that debtors account increased. That means that we allow our customers to owe us, but not to pay. So more customers do not pay us. That means that we do not have cash. If debtors decreases, that means that debtors repaid their liability to us and cash increased. But in that case, debtors increased. That means that we allow or lend more money to other businesses, and that eventually led to decrease in cash. So increase in current assets leads to decrease in cash. Let's calculate the difference one more time. So opening debtors is 8,470, closing debtors 14,190. That means that increase in debtors by 5,720 led to decrease in cash. And the last thing we have to look at are creditors. Creditors increased. Here you can see creditors increased. This is mean that we do not pay for our obligations. So we held cash on our bank account. We do not pay our obligations. So increase in current liabilities leads to increase in cash. Vice versa logic if we compare to the current assets. So we have to calculate the difference. 5,730 less 4,140, opening and closing debtors. Here, opening, closing, and increase in liabilities led to increase in cash. Once we have considered changes in working capital in light blue and changes in working capital in dark blue, we can calculate cash generated from operations. Cash generated from operations. We have to sum up all their items. And here we would have cash generated from operations, 12,700. We can say that that is positive cash. That means that our operations, our main activity, generates cash, which is good, basically. Then we have to consider interest payment and tax payment. But since we have discussed that issue, we can just leave that lines blank because the company has no information. We have no information about interest paid and tax paid, so we assume them to be zero. Interest paid and tax paid should appear here. And cash generated from operating activity would be the same. I will copy the line because only one word would be not the same. So here we would have cash generated from operations. The same amount, 12,700. This is the first subtotal. Which section should appear below cash generated from operations? Cash from investing activities, cash flow used in investing activities. So we have to name that section cash flow used in investing activities. And here we have to list all the purchases and all the sale of non-current assets. And basically that company has only one type of non-current assets, equipment. And we were told that equipment was sold for 900. And we have to consider that sale proceeds because that amount of 900 pounds was never accounted in income statement, only financial result. And that was losses we discussed previously. So we have to state that amount as proceeds from fixed asset sale under investment activity. Proceeds from non-current asset sale in a given amount of 900. Then we have to check, we have to test the line non-current assets equipment in order to make sure that nothing was bought, or maybe something was bought, and we have to consider the payment, the cash spent on that something, and the investment activity and the investing activity also. So payments to acquire fixed assets. Payments to acquire non-current assets. So let's look at the equipment line here. That and that, this and these figures, amounts, are the net book value of equipment. So let's try to calculate, let's try to create an equation helping us to understand whether something was bought. Basically, net book value opening and net book value closing, other factors being equal, should differ on the amount of depreciation charged. So net book value opening was 17 and 50. Net book value closing was 13 and 90. If we deduct depreciation charge is given. If we deduct depreciation charge for the year, we have to receive the closing net book value, but it's not so. Our equation is not in balance, so we have to consider the sold item also. So we have to deduct net book value of sold item. That would be 1,350. And now we can see that the equation is in balance. That means that nothing was bought. Nothing was bought. And if we had here another amount greater than 13 and something, we can assume that something was bought, and that difference, the delta, should be used as payment to acquire fixed asset within cash flow statement and the investing activity section. And now we have just proven that nothing was bought, so for now that line would be blank, would be zero. And we can calculate cash from investing activities. Cash from investing activities. $900 positive. So we have cash from operating activities, cash from investing activities, and the last section of cash flow statement is called cash from financing activity. Cash used or from in financing activity. Under financing activity, we have to consider all cash introduced into the capital, any investment by the owner, any share issue, any share premium, and we have to consider long-term borrowing as well. And basically, I will tell you a little bit of theory. Basically, each and every business is financed from two sources, and that like chart, graph, is called financial leverage. Each and every business is financed by equity, the source or the money of shareholders, and debt. Debt is the bank borrowing normally. And that financial leverage, that рычаг по-русски, depends on the amount of debt and equity within your company. It could happen so that the main source of financing your business is debt and equity is like quite small, or it could happen so that the main source of financing your business is equity, and then we are talking about stable financial position and debt is small. But nevertheless, you have to understand that your business could be financed out of two sources only. So within financing activity, we'll be talking about capital section and long-term liabilities section. So let's look at the capital section. Under the capital section, we see the line which reads cash introduced. And during 2019, the year we're talking about, £600 was introduced in the capital. So it was additional investment done by the owner of the company. And we have to consider it in investing, in financing activity of cash flow. So cash introduced into the capital. 600. We have to consider drawings or dividends paid if it's a large company also. And here we have a line which reads drawings, and it seems that in the year we are interested in, that amount of cash was repaid to the owner as the part of profit. If that was a large company, we could talk about dividends, but in small companies, we talk about drawings. So that amount was withdrawn by the owner of the company in cash, certainly. So we have to consider this as decrease in cash and investing activity. So drawings 8560, decreasing total cash. And the last section, the last thing we have to look for is the change within long-term liabilities. And in that company, long-term liabilities, small company, is the long-term liability is represented by a loan from a person. And we can see that during the financial year, the part of that loan was repaid. At the beginning of the year, it was 10,000, at the end of the year, 4,000. That means that company, Lester, repaid the part of the loan to the creditor, to the person which allowed him to use his personal money. And now we have to show the effect that repayment has on cash on the bank account of the company. Of course, that led to decrease in cash. So loan repayment leads to decrease in cash by 6,000 for that particular case. And total cash from financing activity, cash from financing activity could be calculated now. And it's the only activity which generates negative cash or cash eater, 13,960. And that was the last section of cash flow statement which should be filled in. But the last line of cash flow statement always reads net change in cash. So net change in cash for the period is the sum of these three sections: cash from operating activity, cash from investing activity, cash from financing. And if we sum up all that sections, we will receive net change in cash with minus sign, negative change, 360. This is the final line of cash flow statement. But as I said before, personally, I like the topic that cash flow compilation problems very much because you can check yourself. Eventually, that amount, net change in cash, should be equal to the difference between opening cash, bank balance, and closing cash. So if we consider opening cash in the balance sheet and compare it with the closing cash in the same balance sheet, the difference between these two amounts should be equal to the net change in cash calculated within cash flow statement using indirect method. Indirect method implies that you look at the differences between the changes in current assets, current liabilities, and other things. So we can say that opening cash was 4,060, closing 3,700, and eventually the cash onto the bank account decreased by the 360 we have just calculated. So we can check ourselves, reconcile our calculations. Opening cash, closing cash. Opening cash was 460, closing 3,700, and difference between them is 360 also, which is equal to the net change in cash just calculated. That's all. So we have just compiled cash flow statement as problem required.